Good afternoon and welcome to the Asian Midday Market Watch, powered by Rajhi Bank Malaysia. David Kuo, founder of the Smart Investor out of Singapore, is our guest today. David, good afternoon.
Selamat tengah hari, Brian.
Now, David, I'm going to get your insights on volatile markets. But before that, let's take a look at how crypto markets are performing. Bitcoin is at 36,361. It's down 8.51%. Ethereum is at 2,742.63. It's down 6.89%. Looking across to regional stock markets, and that's pretty much a sea of red. We've got the SGX starting at 3,300.59. It's down 1.29%. Bursa Malaysia is at 1,575. It's down 0.49%. Shanghai is at 2,995.73. It's down 2.35%. The ASX All Ordinaries is at 7,453.3. It's down 2.43%. The Nikkei is at 26,975. It's the only one bucking the trend. It's up 0.58%. The Hang Seng is at 19,984. It's down almost 4% at down 3.9%. And rounding up the numbers, we've got the Kospi, which is at 2,644.4. It's down 1.24%. Now, what's your view, David, on what's causing this carnage?
Well, I think there's a couple of things. First of all, I have to say that, the Asian markets aren't faring nearly as badly as the American market yesterday. We saw the Dow down significantly, 1,000 points, and we saw the NASDAQ down about sort of 4 to 5%. So when you have a look at it in relation to what is happening in America, then I would say, the KLCI down 0.5% really isn't that bad. Hong Kong is an exception because, Hong Kong's got some very specific problems with regards to, with regards to some of those tech stocks that could face a possible delisting over in the US. America has just added a few more companies to its growing list of companies that it has concerns about regarding the auditing of those businesses. So it's very specific, and I would say investors should take comfort in the fact that KLCI is not doing that badly, and Singapore is not doing that badly. Japan is doing quite well, and so too is Korea.
But basically, David, one of the key things that's spooking markets is obviously then Treasury yields are above 3%, and that's worrying investors tremendously. But then what do we do, and how do we invest in volatile markets like this?
Well, there's a couple of answers to that question. The first one, of course, is if you are afraid of volatility, if you cannot stomach volatility, then you shouldn't really be in the market in the first place, because the market is going to be a very volatile place. And at the moment, what is happening is that people are trying to find a value for shares. They're trying to price shares. And the marketplace is a very good place for doing that because it is a discovery of prices. There are some who say that prices are too low, which was what happened not yesterday, the day before yesterday, when the Dow shot up 1,000 points. Then there are those who said that prices are too high, which is why the Dow fell 1,000 points. So we have this two-way tussle between those who are saying that, hey, prices are cheap at the moment, you should go in and buy. And those who are saying that, hey, it's far too expensive, inflation could be a big problem, the Fed is behind the curve, and the problems over in Eastern Europe are not going to be resolved. China is not going to get a grip on the COVID situation. So therefore, let's bail out, let's get out. And so we're going to be getting this tussle. But I think we need to invest with our heads rather than our hearts. And what that really means is that you need to look at companies. I look at the Dow yesterday. Every single component of the Dow Jones 30 index were down. And I said, that doesn't make any sense. How can
that's a buying opportunity for people like you, right?
Well, it's not just a question of opportunity, Brian. It's just a case of it doesn't make any sense. Are you telling me that oil companies need to be marked down? Chevron needs to be marked down when oil prices are rising? Are you telling me that banks need to be written down because interest rates are increasing and therefore they're going to make more money from the net interest margins on their businesses? It doesn't make any sense. So therefore, when I see a market like that, what I see not is a sea of red, but a red sign saying for sale, right? And it just means that if you have got a good head on your shoulders, you should be able to go out there and pick some pretty good stocks and say, these are the companies I want to buy. I mean, look at Starbucks, for instance. I mean, Starbucks is yielding 3%. It's never yielded 3%. And you have this
That's
coffee
your
trade.
T-bill rate.
Well, exactly. So therefore, why wouldn't I buy Starbucks? Are you saying that Starbucks outlets in China are going to remain closed forever? I mean, I don't think that's going to happen. So therefore, it is, for want of a better word, it is a buying opportunity.
Now, David, just a few hours, you talk about interesting stocks. Just a few hours ago this morning, Chinese electric car maker NIO announced that it's planning a secondary listings on its ADR receipts in Singapore. Now, that's obviously to expand its investor base in Singapore, and it has already received an eligibility to list letter from the Singapore Exchange. What's your view on this, and do you see this as perhaps the start of a trend then, as companies, Chinese companies in particular, start to move away from the US, but need another listing outside of China or Hong Kong, perhaps?
Right. We need to be very careful here, Brian, and I'll explain why. The listing here in Singapore is fully fungible with the ADR in America. In other words, it's fully exchangeable with the ADR in America. Now, NIO has been listed to that list of companies which is facing regulatory concerns with regards to its auditing. Now, if NIO were to be booted off the American Stock Exchange, what is the Singapore listing going to be fungible with? What are you going to exchange that with if there isn't an ADR? So that is something that people need to be concerned about. But that is not to say that NIO may not in future decide to actually have a full listing in Singapore. If they were to do that, then you would have a look at that company and say, is it a company that I would like to invest in? Now, NIO has been growing its revenues, doubling its revenues for the last 3 years. It is still loss-making at the operating level, and it is also loss-making at the bottom line, but it is making a gross profit. But it is a startup after all. And so therefore, there is a possibility that the company could become profitable. Now, will these companies decide to list in Singapore? That is definitely something that people need to think about and say it is a possibility. And it would give investors an opportunity to invest in a company that is certainly very exciting. I can't think of many companies here in Singapore that can grow their revenues 100% every year going forward. And in the case of NIO, it could provide investors here with an opportunity to get in on the tech sector rather than just rely on boring old REITs like me.
But, you know, David, on the flip side of the equation, one of the key things that I think companies look for is valuations. And places like Singapore, the Singapore Exchange, while being well regulated, unfortunately doesn't give them the same valuations as perhaps US markets do. How do you think that's going to play out, especially if the door is closed on them in the US?
Well, maybe it will just take time. I mean, we have to understand that the Singapore investor, generally, I wouldn't say all of them, but generally they would say, I want a company to pay me a dividend. Otherwise, I'm not interested in investing in you, which is why REITs are very popular over here. I mean, there are very few stocks that you see in America that will give you a 4-5% yield, just don't really exist. And even those REITs in America pay you a very low yield, but instead they say, we promise you growth in the future. Now, Singapore is very specific in the sense that we have very conservative investors, and companies that tend to list in Singapore or have an opportunity to list in Singapore, but don't, but instead choose to list over in America or Hong Kong. I mean, Razor is a good example. C Limited is another one. They chose to list somewhere else because they said we don't get the same kind of valuation here in Singapore. That is understandable. So we have to understand the markets that companies choose to list in. And maybe in the case of NIO, it could be a sign of a change in sentiment. And they're saying that we're giving Singapore investors an opportunity to invest in a growth company that doesn't quite pay a dividend yet. They may do in the future, and there's no promise of that. But it could be a sea change in the way that companies will start to think about where they want to list and whether or not they're going to give investors an opportunity to invest in those type of companies that don't pay dividends.
Now, David, as always, thank you very much for coming on the show, and thanks for your insights.
You're welcome. Thank you.
Now, we've been speaking to David Kuo, the founder of the Smart Investor out of Singapore, on Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as Rajhi Bank's social media platforms. Please like and subscribe to our various platforms. Thanks again for tuning in.